Okay, welcome to the third in this little suite of videos looking at the analysis of import tariffs, tax on imported goods. Here's the analysis diagram we built up in the last video. The reason for the labeling of the areas is that this then allows us to think about the impact of a tariff on economic welfare, in particular consumer surplus, producer surplus and community surplus, the sum of the two. So really important to think about what the impact of a tariff is. Keep it nice and clean. Take a particular stakeholder and just talk about the impact and offer a brief reasoning. If we think first of all about domestic producers, in this case we were talking about Cambodian rice growers. In theory, a tariff means that supply will expand. They move up their domestic supply curve because they're getting a better price after the tariff, and that provides a profit incentive for them to move up their supply curve. Domestic demand will contract because relative to the free trade price, a tariff increases prices, effectively reduces real incomes of consumers, and therefore domestic demand will contract in the absence of an offsetting factor. So we're really looking at what's called ceteris paribus. What's the impact of a tariff? Other factors held the same. The volume of imports should go down because domestic supply has increased, expanded. Domestic demand has contracted. There's a little bit of import substitution going on as people switch back towards domestic growers in this case. Tax revenue should be higher in theory. As we said before, tariffs for many governments are quite a big chunky source of tax revenues, so the tariff will raise revenue, depending of course on the volume of imports that persist after the tariff. Domestic producer surplus, the area above the supply curve and below the price, that's going to go up. The domestic growers, in this case in Cambodia, will get a better price for each unit sold. So producer surplus will go up, but consumer surplus, domestic consumer welfare, will go down because they're now having to pay higher prices. Don't forget, we're analysing here. Part of the evaluation is to calibrate and quantify and look at the relative costs and benefits of tariffs, and also the second and third round effects, the consequences. Overall, we mooted that economic welfare would go down. There's going to be a net loss of economic welfare because the loss of consumer surplus is not fully offset by higher producer surplus or the tax revenue going to the government. There were two areas, if you remember from the last video, of deadweight welfare loss. Inflation on the macro side, well, tariffs typically raise inflation. Certainly in the short term, if you increase a tariff, that increases the cost of imported products. It could be final products like a washing machine or a car. It could be component supplies, raw materials. So tariffs are a source of cost push inflation. What about growth? Well, in theory, in the short term, tariffs provide a stimulus to domestic production, higher level of domestic supply. But of course, again, the higher inflation could cut real incomes and actually have a downward effect on tariffs. I was reading a report from Bloomberg Economics that the trade war between the United States and China had cost the United States economy something like $300 billion by the end of this year. Many US companies have seen their share prices go down, for example, in partly as a response to that. The evaluation, we'll do a separate evaluation video on tariffs, really asks you to think about the quantifying and calibrating and examining the impact of a tariff, and also challenging the assumptions built into the model. But when it comes to analysis, that key diagram, keep things nice and simple and straightforward. Impact on prices, outputs, welfare, and also those key macro variables, inflation and growth. And if you do that, you won't go really far wrong and get really good marks for your tariff questions. Okay, thank you.